Hello, everybody. Today I'm going to talk about 9 proven ways to boost your index fund returns. That should be something that excites you. I know it excites me. I'm an index fund investor, and I'm simple, and I'll let you know a proven way to boost index fund returns in a second. But first, I want to introduce myself. My name is Rich Carey. I have a blog called richonmoney.com. And I talk about how to invest, how to save, how to invest responsibly in real estate. I'm in the military, and I have a portfolio of 20 homes that are paid off. So I've been doing this investing thing for a while now. Okay, before we get started, let me first say that if you find this helpful today, give me a thumbs up. Give me some encouragement, leave me some comments, and subscribe. All right, let's get started. I'm going to get through this quick. I want to explain this to you. 9 proven ways to boost your index fund returns. Paul Merriman is the person who started this. He's been preaching this ultimate buy and hold portfolio for the past 20 years. He's a nationally recognized authority on mutual funds, index investing, asset allocation. He ran his own investment advisory firm since 1983. He's been on Wall Street since the 60s, so he's been around a while. What this thing is, it's very interesting. I just invest in like index funds, like straight up. I just do index funds. And I do like S&P 500. I put all my money there and I just leave it. This is kind of like taking that strategy and what was that guy's name? Emerald, like kicking it up a notch, right? You're kicking it up a notch by using some different asset classes and diversification. And it's really exciting stuff. What he does is instead of having 100% in S&P 500, he still uses the S&P 500 index as the base. But he's going to put 9 other sort of asset allocations in there, each in 10% increments. So you're still going to have 10% of S&P 500, and then there's going to be 9 other assets in 10% increments. So I'm going to explain this to you guys, what those other 9 are. And I'm going to do this using where did I put this thing? I thought I wrote it down here. Using a like $100,000 sort of fake investment as a example of what would happen. So let me get to the right part on here where I can explain what he has said about the S&P 500. Okay, according to his research, he said that the S&P 500 has compounded at 9.3% between the years of 1970 and 2016. I think that's 46 years. He said 9.3% is what it's compounded at. So we're going to use that time frame to compare this portfolio of just S&P 500, $100,000 invested in 1970, what it would be in 2016, versus this ultimate buy and hold portfolio with all these like changes, with all these extra sort of like diversification in it, and how much that boosted the returns, right? So $100,000 invested at 9.3% grows to $6.5 million between 1970 and 2016. And that's where we're starting all of this off in what we'll call Portfolio 1, which is 100% S&P 500 index. Now let's figure out, let's add the first part of his recipe, and that is what we're going to call Portfolio 2. What does he add the S&P 500 index to start things off? He starts off with U.S. large cap value stocks, which are large companies that are regarded as relatively underpriced. So only 10% of the portfolio has changed, and 90% is still S&P 500. And by doing this, it goes from 9.3% to 9.7%. And in that time frame, it goes from 6.5 million to 7.8 million. So it's a pretty big jump. It's actually a 19.3% increase, right? From just changing from 9.3 to 9.7. It's a lot of money, right? These small additions, in compound returns can make a lot of money over a lifetime of saving, or in this case, just it's 46 years. So there's a couple more of these to go. Let's do portfolio 3. All right. He adds next U.S. small cap blend stocks. Small cap stocks have a long history of higher returns than the S&P 500 index, not only domestically but internationally. So what does this do? Well, this boosts the compound return yet again from 9.7 to 9.9, right? And then boosts the growth again from that time period. Now you're getting 8.3 million. So you're starting off, instead of 6.5, just for these two changes, now you're at 8.3 million just by adding 10% each of these two things to your portfolio instead of just leaving it all S&P 500 index. Let's move on. All right, let's keep hearing about this. I'll call it portfolio 4. We add U.S. small cap value stocks. That actually has historically been the most productive asset class, value, small cap value. That's what he's kind of biggest on. It boosts the compound return on this whole portfolio to 10.3%. Boosts the growth to $10.1 million. That's double digits. We started off at like 6 million, right? 6.5 million. We've added 3 different things in 10% increments, and we're now at $10.6 million over this 46-year period. That is a massive growth. Let's move on. Portfolio 5, he adds REITs, REITs, real estate investment trusts. Real estate, something near and dear to my heart. It just adds a slight edge to the portfolio, but it's still worth it. It only goes from a compound return of 10.3 to 10.4. How much money does that mean? It goes basically from 10.1 to 10.6 million. That's $500,000. That's worth it. I mean, $500,000 isn't something to laugh at. So that's like definitely worth looking at. Let's move on. Now that we've done these first 5, portfolio 5, let me say a couple things real quick about this. We already said that portfolio 5's impact was kind of minimal, but it's still important. Portfolios 2 through 5 had a lower standard deviation, okay, and that basically means that they had lower risk than the S&P 500 itself. So by adding these things in, we have not increased the risk. We've actually decreased the risk a little bit. And that's pretty amazing. You've decreased the risk, and data to prove that. But you've also proven that you have you're making more money. That's like a no-brainer, so run with that. The rest of the portfolio after this is when you start adding international stocks, right? So you could stop right here. Like you could be like, I don't want to add international stocks. And you could just go with portfolios 1 through 5, just add these 4 things and like be done with it. But I'm too greedy for that. I want to make more money. So let's move on. Portfolio 6, we're going to add 4 international asset classes in 10% increments, which will reduce the S&P 500 index to only 20% of the total. After you add these 4 different ones in 10% increments, you're going to add international large cap blend, large cap value, small cap blend, and small cap value. You're adding each of those in 10% increments. That boosts your compound return to 11.1% and your growth to, drum roll, $14.1 million. Are you kidding me? No, I'm not. I'm serious. Now let's take a pause here. I just want to pause at this point. I want to give a shout out to all the people watching me live on Facebook. I'm going to say all your names. Maybe I'll go alphabetically. This might take a while. Just want to say your names. Hey, Oh, wait, that's not funny. Well, that's messed up. Oh, all right, maybe nobody's there right now. That's okay. I'll continue. We'll keep talking about this. Portfolio 6. I've already done that. That's the 4 international small cap, large cap. The last one now, portfolio 7. When we add this one in, then it'll be 10% S&P 500 and 10% everything else. And this boosts things a little bit more. Emerging market stocks, all right? Emerging markets. This one is the only one that has more volatility than the S&P 500 index out of all the ones I've listed so far. It only has a little bit more, and it's not enough to worry about, but it actually is higher than the S&P 500 when it comes to volatility. It boosts the compound return of this entire portfolio to 11.3%, and growth, drum roll again, is 15.3 million. What? We have gone from 6.5 million to 15.3 million by adding these 9 different asset classes and just slightly boosting each time. But it's just massive, massive growth. It'll make a huge difference, all right? You could definitely switch brands of toilet paper and have a little bit nicer car and maybe eat surf and turf instead of TV dinners for the rest of your life with that kind of difference in money. So I'd highly recommend it. Disclaimer time, I am not a financial advisor and I cannot predict the future. Index investing is based on a belief that these trends seen in the past will continue into the future. That is likely, but there is no guarantee. This portfolio could lose more than the S&P 500 index in a bear market. More volatility. Choose your investment strategy at your own risk. That was lame, but I want to say that. Paul Merriman points out the following guidelines. Most academics agree that stocks will have higher return than bonds. Small caps will perform superior to large caps, and value stocks will perform superior to growth. And I want to believe all these things. I do believe all these things. I think that's going to be the case. It has been the case in the past for a very, very, very long time. However, as the old saying goes, it is difficult to make predictions, especially about the future. If you liked if you got this far, I commend you. I'll send you like $20. Please comment and give me a like and subscribe on Facebook, and peace out.